those people saying the market's about to crash or whatever is simply, don't know what they're talking about. The market is fundamentally sound and will continue to go up in value over time.
Who caused the property boom then?
The boom is caused simply by the fact that we haven't got enough properties and too much people wanting to buy properties. We're not building enough homes. 80% of our population growth is coming from overseas arrivals. The demand for housing generally keeps on going up.
So if demand keeps going up, then there's a low likelihood that some of the prophecies of the Australian property market crashing coming true.
If supported by genuine demand for property, it won't crash.
Welcome to the Property Addicts Australia podcast. Today we are joined by John Lindeman, property analyst and former head of research at Residex. It's been a confusing couple of weeks since the federal budget, and we wanted to speak with John to find out the views around where to next with the Australian property markets. John, welcome to Property Addicts Australia.
Thank you very much. It's great to be here once again.
Thanks, John. So, John, it's been an interesting few weeks, and all of us in the property industry and property investors are trying to get our heads around what's actually happened.
Yeah, indeed. My inbox has been flooded with all emails and newsletters and podcasts offering information, advice. But I think, we really have to look at this in two ways. One is, what is the impact likely on the property market itself? And then look at what impact is likely to occur for investors. And if I can talk about the market generally first, I think a lot of people don't realise that 70% of properties in Australia are owner-occupied. That is, they're not investor-owned. And of those, about half of those are owned without a mortgage and the other half where people are paying off a mortgage. Now, the changes to negative gearing and capital gains tax don't affect that 70% at all, because if you're buying a property, you can't negatively gear to live in, and of course you don't pay capital gains tax. So it means that 70% of the market pretty much is immune to these changes. And so what we're looking at is, 25, 30% of the market which are investor owned. So I think the vast majority will continue on as before. It won't have any effect on them whatsoever. And so, those people saying the market's about to crash or whatever is simply, don't know what they're talking about. The market is fundamentally sound and will continue to go up in value over time.
So, John, that brings me to the question, who caused the property boom then? Because if 70% are owner-occupiers, everyone blames negative gearing and property investors for the boom. So who caused the booms then?
Well, the boom is caused simply by the fact that we haven't got enough properties and too much, people wanting to buy properties. So yes, they've always gone up over time. And once you get into the market, you look at it more closely, you see that first-time buyers, yes, they need to borrow a lot of money. But when they start to upgrade over a few years, they increase equity and their borrowing power increases and their buying power. So, there's no top end to the market, and it will continue to go up as long as we're not building enough properties. And that's really, the one issue that the budget didn't cover at all is the fact that we're not building enough homes.
So we have a shortage and there is a substantial amount of new Australians or new people arriving into the country over the coming years.
Yeah, I mean, we've got, nearly 80% of our population growth is coming from overseas arrivals. Now, they don't come here and buy property straight away, but they still need to live in property, so they become renters for a number of years, or most of them do. So, the demand for housing generally keeps on going up. But the problem with that is that you say, well, why don't we cut migration? And that is that we rely on migration to keep our economy in growth. So it's really a matter of if we cut migration, we could easily slip into recession because it's the people coming into the country that keep on creating more demand for products and services. And so our economy keeps growing.
But where will these people live really, right? The government wants to encourage people to buy brand new properties. Construction costs are all too high. These people would come and live in capital cities where vacancy rates are all-time low.
Yeah, I mean, overwhelmingly people come from highly industrialized and, westernized countries by the whole. So it means that they're going to want to live in capital cities. They don't mind living in units, but the demand in our capital cities for property will continue to go up because of that preference for inner urban living.
So if demand keeps going up, then there's a low likelihood that, some of the prophecies of the Australian property market crashing coming true.
No, I don't think so. If it's supported by a genuine demand for property, it won't crash. The worst event we ever had in the Australian property market history was the Great Depression, when unemployment reached 25% of the population and wages fell, and the property market fell by about 18% over 5 years. Now, that's the worst it's ever done. Generally speaking, there have been little crashes and so on around in mining towns and so on. But when you look at the whole market, that's the worst it's ever done.
But John, this happened in 1985 as well, right? Negative gearing was scrapped and rents rose double digits, I guess, like in percentage terms, and it was reversed. So do you think that might happen again? Because, we have more migration than ever before, than definitely more than 1985.
Well, when you look at negative gearing, it's something that affects when you enter the market as an investor and you're buying a property that costs you more to hold than what the rent generates. That's what we call negative gearing. After a few years, most properties become positive cash flow anyway. So the longer you hold a property, the more the higher the rent yield becomes, and so all properties should become positive cash flow over time. So it's really only a temporary thing. The main issue at the moment is that if negative gearing is done away with over time, which is what the government's proposing, it will make it harder for investors to enter the market, because they're going to find that the banks are starting to factor in the holding costs in a way that they didn't do before, because you could claim back the costs. Now, if you can't do that, then of course it will reduce your borrowing power as a first-time investor.
First-time investor, but if you're an existing investor, you may already have one or two or more properties. Should rents rise, then you can get another investment property and pretty much offset that negative gearing against that rent. So I think existing investors are not so disadvantaged in comparison to someone who's starting out today.
Exactly right. And in fact, it benefits existing investors, because what they can do is, as you said, they can offset the losses on one property against the rental income from others. So it means that they're actually better off than they would have been.
But doesn't that create a divide in what people say, and something that I don't, always believe, that rich are getting richer and poorer are getting poorer, given, existing investors still benefit even under the new changes?
Yeah, it just makes it a little bit harder for people to enter the property market as investors. I think the one segment that's really badly affected are rent investors, people who decide to buy an investment property before they buy their own home to live in. That does really knock them around. So yes, harder to start up. It means that you'll be able to borrow less money. Some are saying about 20% less, So what is the solution to that? Well, it is to look for areas which are not negatively geared. In other words, where there is positive cash flow opportunities either now or in the near future. So it will change the nature of the market, in that investors starting up will look to those higher cash flow areas in ways that they didn't do before.
John, before we dive into that, I also wanted to touch on New Zealand, right? New Zealand had some significant amount of changes to their, tax laws a couple of years ago, and they had to wind them back. And it was something along the lines of what's happening in Australia. Could you shed some light on that?
They, in 2021, I think it was, they abolished negative gearing, but then when the new government came in 23, they reversed that change, because what they saw was rents rising dramatically, because people stopped buying investing in investment properties. So in New Zealand, it had but the difficult thing about that is that at the same time, interest rates fell dramatically in 2021. So, what caused the change? Was it the change in negative gearing or rates going up again? Because since then they've gone up dramatically. and the New Zealand property market hasn't really gone anywhere in the last 5 years, but rents have now gone back to where they were. So, but you can't negatively gear in New Zealand anyway. What you can do is you can do that offset against other future rental income. So they've left that as it is, but there's no capital gains tax in New Zealand either. No stamp duties. There's a lot of benefits, but there's just the difference. The main difference is that there's also no population growth in the way that we have in Australia. So it's a very sort of static, stable market.
But don't these changes impact the state government revenue as well with less stamp duty? Do you see though the rents really increasing and state governments getting upset with what's happening?
I think they might, and those that rely on stamp duty heavily, like Victoria. But I don't think it's going to stop investing. As I said, it's just going to mean that people will buy higher cash flow properties, maybe lower priced properties. So it's going to change the nature of the game. But I think it's not fundamentally going to change the market as a whole. It's just going to change where the investors will concentrate.
So it's not like the end of property investing in Australia as of now.
No, not at all. And you have to remember too that the capital gains tax changes apply to all investments, shares, gold, commodities, commercial property, everything. So where you tend to buy property for a number of years, people will buy a property, say for, 5, 6, 7 years. Well, if we get inflation at around 4 or 5%, then the amount you'll be able to index off the capital growth will be about 50% anyway. If inflation goes up, you could even be better off than you are under the existing 50% exemption. So, but really, because it applies to all forms of investment, and people tend to buy property for longer periods of time, they buy and sell shares all the time. So it's going to affect, I think, other asset classes more than it will affect property.
But people also are changing strategy though, right? Like we've had clients who said, well, I can't possibly afford $25,000 in negative cash flow anymore, especially those looking to invest in Melbourne. We've been buying in Melbourne for the good part of last 18 months for our clients. So people changing that strategy and moving the funds into shares instead to pay down their owner-occupier debt before they do anything, right? It's really changed people's plans. Like how many people can afford 25 grand negative cash flow?
But then we've also had clients who've tweaked their strategy and said, look, I'd rather buy 2 apartments, for example, high yielding apartments, pay them off over the next 5, 10 years, and generate some cash flow because I don't really know how my income will be impacted as time goes on with, AI changes in job market and all. So I think people need to have a longer term view like this rather than thinking, oh, I'm not going to invest just because regulations have changed and they don't work for me, but find solutions and work around it because ultimately the goal is the same for most people, right? People want some sort of financial freedom. They want some assets backing them up. It is a little bit harder, but you need to just work around those rules and move forward.
Yeah, very much so. And I think another important consideration is the fact that rental yields at the moment in Australia are at historical lows. We've got 4 or 5% general rental yield, and that's way below when I look at the average, it's about 7 or 8%. And when you look at the way that rents are moving, you can see that the rent demand is increasing. We're not building enough properties. That means that I think this whole argument will disappear in a few years because there won't be any negatively geared properties anyway. Yields will go up so much that everyone will be saying, oh, you buy property and you're making money from day one. So it's a temporary thing, but I think it's not going to, it shouldn't turn people away from investing. It might change where they're going to buy and what they're going to buy. I think that's relevant, but I think the whole thing in a few years, we'll look back and say, what was all that about? Because yields are now so high.
Oh, sorry, I just have a thought. What I learned in our journey, especially early on, back when we were buying in Sydney, some of the western suburbs, the yields were like 7%.
Yeah, really go back.
Yeah, it might go back to those levels. And what I learned was that the capital growth cycle and the rental growth cycle are actually inversely related to each other. And because rents haven't caught up to the prices, perhaps rents will catch up, and then property investing will become so good or so attractive that more people will jump in, and perhaps that capital growth cycle will start over again. But that's just my take.
But that would also mean, though, tenants think it's cheaper to actually buy a property than rent anymore as well.
If they can, yes. But yeah, and we have had moments like that in the past where it was cheaper to buy a property than to rent. But then again, more people wanting to buy property because then forces the prices up, and so you get the growth kicking in, as you said. But yeah, we are heading for, I think, a sustained period of higher rent growth and lower capital growth, unless, of course, you look at these areas that we've done. What I did was, we've got a database that analyses all of Australia's 15,000 plus suburbs and towns. And so I did a what-if analysis. I said, well, what if these changes are made? Which areas are likely to benefit from them rather than be punished? And surprisingly, I came up with about 71 suburbs and towns around Australia that are actually going to see increased cash flow, increased price growth, and higher yields because of the federal budget changes. So, again, if you know where to look, then you can do very, very well.
But would that include even Melbourne, where the supply has generally been a lot higher, supply of houses, and of course they've done a better job of building, but would Melbourne rents rise as well?
Some of them, yeah. I think those 71 suburbs that I mentioned, we found all over every state and every territory. There was some, but in Melbourne, it was generally the inner urban units. That's where the yields already are at 7-8%, and they're going to escalate a lot more. So places like Brunswick and Footscray, Carlton, those inner urban unit markets, 2-bedroom units you can buy now if you're under 500,000, which is really quite amazing. Really good investment opportunities, and that's in Melbourne, but there are opportunities all around Australia.
Yep, or even in Sydney, we've seen, right? Western Sydney, there's been an increased amount of inquiry that units are getting now, and multiple offer situations happening already.
But, there was a time though, right? Well, Mona and I built our portfolio on strata properties. That's what we could afford, and that's what we bought. Villas, townhouses. And generally, though, we've seen a shift in our client base where they've wanted to buy houses because land holds value. And now we're going to see the shift the other way, potentially preference for strata properties again.
Yeah. You have to remember too, I think, that with a lot of the overseas arrivals, people coming from, big cities and areas where they're used to living in medium high density type properties. So they don't have any issue with that at all. And so I think that, yes, the demand is changing back to those, the smaller units, duplexes, townhouse type accommodation.
And I wonder if people will also have to tweak their strategy. Like, previously the idea was pay off your owner-occupied debt as fast as possible. Again, I guess it's all subject to tax account and advice. If you're not planning to sell a property for a very long time, or you're not going to sell it anyway, do you consider paying down one investment property first and then free your borrowing capacity, and then go again and buy another investment property after?
Yeah, I think you're much better off buying an investment property, even under the new rules, than buying a home and paying it off, because you can't. The things you can claim when you buy an investment property, like the interest and so on, you can't do that with a family home. So really, and it means that you're going to get ahead much quicker by buying investment properties. And the other reason for that is you can buy in areas which have got really high cash flow and price growth potential. I think in the last podcast we did, I mentioned, was it Port Augusta in South Australia? Now the growth since then, over 30% price growth for a 2-bedroom house, and the yields are well over 7%. The rents have also gone up astronomically. So, even if from that podcast to this, you can see the potential, and yet you can still buy in Port Augusta for around 300,000 for a 3-bedroom home.
Well, John, if I may say so, I did post about it on our Instagram, and that post went viral. Yeah,
well,
people have mixed views, but yeah.
Yeah, I mean, it's very much, you've got to look at the industry, the nature of Port Augusta and maybe say, well, I wouldn't want to live there, but that's not the point. It's that other people do. There's a lot of new industries, green cement, and so on. The Whyalla Steelworks is being revitalised. There's a lot of opportunity there, and the state government is driving a lot of that and investing in that area. So yeah, a lot of potential.
And John, just on the note, you said that people may still be better off buying an investment property than their home. I'm of the view, say, people who have been rent vesting and they already have a portfolio, then it may make sense for them to potentially consider buying their home next, because if they're renting, their rents might go up substantially, right? If you're gonna get into a rental boom over the next few years, their rental properties would be deriving a lot higher rent, and then they can now put that money towards their own mortgage as well.
Yeah, I think it depends on individual circumstances, and of course, I'm not an advisor in those sorts of matters. But you might be living at home with mum and dad, in which case you're not really paying much rent at all. So you're much better off buying an investment property. You can claim all of the holding costs against the rental income from your investment property, and if you're buying in an area where that growth potential is huge, like I've mentioned, inner urban units in Melbourne or Port Augusta and other markets where there's huge potential, it gives you the opportunity of living where you want to, but investing where the opportunities are the greatest.
Absolutely. And I know there's, a lot of impact on a lot of people with capital gains tax changes and young people saving up for deposits and all. So they would have to weigh up, right? Like look at different strategies and getting in the market, like guarantor loans and getting parents' help really to get that deposit and get the foot in the door quicker.
Yeah, but it's still, if you think about buying a unit for around 400,000, which is possible in Melbourne, or getting a house in Port Augusta, or there's many other places. We've mentioned in WA, there's the gold mining towns, which are absolutely booming at the moment. Kalgoorlie, Coolgardie, rental yields up to 10%, and you can buy a house there for under 300,000. So that's affordable, and young people can do that. And the house it's paying for itself. It's positive cash flow, and you're on the ladder to getting financial freedom in future.
But wouldn't mining towns, right? What other industries would these towns have to support a sustained growth if, say, mining was no longer there, which we've seen in the past?
Yeah, we've seen some spectacular crashes in the past, but I think most of those days are behind us, and a lot of that was caused by the way the industry was structured, and they had fly-in, fly-out workers who rented, and the rent demand shot up in towns like Port Hedland in WA or Moranbah in Queensland, and then prices went up to over $1 million for a house in Moranbah or Port Hedland. It was crazy stuff. Now those days have gone, and when you look at the demand now in Port Hedland and Karratha, those ports and mining towns, it's much more sustainable. The industry itself, iron ore, has got a long-term future. When you look at the gold mining towns and the Coolgardie and Kalgoorlie and those places, again, there's plenty of gold there. It really just depends on the price of gold. And when you look at the way it's moving, the more uncertainty there is in the world about what's going on in the Middle East and elsewhere, the more the price of gold goes up. So, and you're not buying for 10 years, you're just buying to get that foothold in the market. And as long as those commodities keep rising in price, and it looks like they will, then you've really got no greater risk than buying anywhere else. So I don't think it's a great disincentive. A lot of people avoid, one industry, mining towns, but I think if the commodity itself has got demand and supports a whole community of people who want to live in that town, then there's no problem.
And I guess touching on various parts of the country, because Brisbane had been running for such a long time, right? Since 2020, it went crazy and became quite unaffordable. Perth as well, Perth and surrounds has had substantial amount of growth, and similar in Adelaide, really. So where would you put these places, and what basket would you put them in? Do they still have any upside, or there are better opportunities?
Well, Perth, Brisbane and Adelaide are what we call mature markets. And what I mean by that is that the growth started 5-6 years ago, and it was all at the bottom end of the market in Perth and Mandurah and Rockingham. In Adelaide, it was all in the Elizabeth Salisbury areas. And in Brisbane, it was in Logan and those sorts of, very affordable markets. And then the growth expanded from those. It rippled up into the middle part of the market over the next few years as people upgraded and sold their properties, bought better houses. And then it's finished the last few years. All the growth in Brisbane, Adelaide and Perth has been at the top end of the market. So you look at, like in Perth, double view, 50% price rise in 1 year. The same in Adelaide at the top end of the market and Brisbane. So what are these people who live in those areas? They are older people, they're 55 plus, they own their homes without any debt. The kids have gone. And so the government says, look, if you want to sell your family home over 55 years of age, we'll allow you to put 600 grand into your super fund tax-free. So there's a huge incentive. If they've seen prices go up, they can now use that and put the $600, $1,000 into super tax-free and secure their financial freedom. So what's happening is when you look in Perth, you'll see the older people selling their homes and moving to places like Busselton. Now, Busselton went up over 30% in the last year. In Adelaide, they moved to places like the Fleurieu Peninsula, and we've seen Victor Harbour and those sorts of areas going up by similar amounts, over 30% growth. And the same in Brisbane, people moving to places like Hervey Bay, and again, over 30% growth just in the last year. So people are downsizing is what we call that sort of trend. So yeah, the growth is going to slow down in Perth, Adelaide and Brisbane, but as it slows down, it's speeding up in the areas where people are now downsizing too. And that's not happening in Sydney and Melbourne. Why? Because there's no growth at the top end of the market. It's all at the bottom, and it'll take years before that starts to happen in Sydney or Melbourne.
Well, I think what we might also see is a shift towards self-managed super funds, right? Because speaking with clients, often what they complain about is, oh, our industry fund is not giving enough return. I'd be better off buying property with growth and with rental income in the future. And the rules haven't changed there.
No, they're exactly the same. So yeah, it is a great vehicle for the future. I mean, over the longer term, the important thing about buying property in a self-managed super fund is that it needs to be cash flow neutral or positive. Otherwise, you're drawing money out of the fund to cover your holding costs instead of putting them in. So again, looking for those areas where the cash flow is strong is really important. And of course, you're going to be holding that property for quite a long time. And so the inflation indexing could actually work in your favour, because it could be more than 50% if you hold the property, say, for 10 years. So you're better off under the new rules than you would be under the old.
And John, I guess, the construction costs have been all-time high, and over the last few years, I haven't seen a lot of marketing from spruikers that sell off the plan properties. They used to be really, really common, and some 7-8 years ago, they were everywhere, like on social media. We might see a return of those spruikers again, and they will sell the dream of negative gearing to people. So what would you say to someone who's making decisions based on that?
I think it's a massive trap, and you get the project marketers and developers pushing this, house and land packages and off the plan units. It all looks too good to be true. They'll give you rental guarantees. I know a few years ago back in Perth, before the boom started, there was one developer who was offering double your deposit. So in other words, you paid a small deposit, and then when at settlement, they would give you twice what you'd paid back, as part of the settlement. And that sounds, of course, incredible. But what people didn't realise was that was just all added into the purchase price. So the loading that goes on for rental guarantees, it's added into the price. The commissions that, people get offered huge commissions, and I've been offered these myself. The developers have come up and said, John, we've got this massive big development going on in some place up north, and if you promote it in your very podcasts and so on, one of those units or one of those blocks of land has got your name on it. That sort of inducement does
Wow,
occur. Yeah, and
that's huge.
yeah, it was, and I naturally said, "Look, I want nothing further to do with you because once you do that, you're in their pocket. It's completely unethical. So I would never do that." But nevertheless, even just people who, some buyers agents will say, "Look, if you push these properties, you get 10 grand per property." All of that's loaded into the price. So I'd say stay right away from them because not only are they overpriced, you don't really know what the value of the property is because it's never been sold. And quite often they're not in the right areas. So all new developments, house and land packages are on the outskirts of towns, out of suburban areas. There's no facilities, no services yet. So don't fall for it. And these will be people you won't have heard of before. As you said, they'll come out of the woodwork now and start trying to sell off the plan and house and land packages because of the negative gearing benefit.
Well, we've had clients who in the past, say 2017, were sold these house and land packages in say Queensland. 2017, right, when the market wasn't doing anything or not doing a lot, and they paid like premium prices. The properties didn't move. Eventually, they did well, right? Like time heals in property, time heals eventually. But the opportunity cost was massive. And like in the past, right, we've also come across people, say in 2009, bought a brand new townhouse in the Logan region for 320K when you could have bought a house in 2009 in Sydney for a similar price in Western Sydney, and maybe bought 4 or 5 properties and built a multi-million-dollar portfolio. So the opportunity cost of these properties is massive.
Mm. And there's another problem as well, and that is that when you look at the large sort of house and land type developments, and we've driven through a lot of these, and you can always tell the ones that are investor owned because the lawns aren't mowed, and too many investors buy properties. There's not enough rent demand because in those sort of outlying areas, the rent demand is very low, and so immediately once the rental guarantee runs out after a year or two, you find that you can't get tenants, and you've got to drop the rent right down. And with the high-rise unit blocks, for the same thing, they're all completed at the same time, rental guarantees offered, and then when the rental guarantee expires, suddenly all those units, which didn't really have tenants in them because they were just supported by the rental guarantee, and you start looking for tenants and there's not enough around. So, they have a lot of opportunity for disaster written on them.
So why would a developer offer you such a deal if it was such a good deal? Like, why would they offer you a rental guarantee? A property should be able to rent itself out without any challenges.
Well, the reason they do it is because they need finance from the banks. And so they go to the bank and say, we're going to build 100 units. And the bank says, well, when you've sold 20 of those, we'll give you more money to build the rest. So they have to sell the initial 20. How do they do that? By offering all those guarantees and incentives. So once they've got 20% signed up, then they can go back to the bank and say, look, we've got 20% sold. And the bank says, all right, now here's more money to build the rest. So they tend to build them in stages. So it's in the developer's interest to offer these guarantees, not in the property owner's interest.
Well, early in business, right, I had these prospect clients. They were being offered this brand new house and land package. And I told them, this is not right for you. This is not the right direction. And unfortunately, I can't help you even with the even with the finance, because I mean, I can't see you going through that. And Mona has come across clients like later in the maybe 40s or 50s who have bought apartments where
I've had clients who had registered some apartments in 2017 or 2016, maybe right at the peak of the Sydney boom. And then I think that the apartments were ready in 2023 or 2022. Like, it took such a long time. Many markets moved in that time. So you can't just tie in your resources waiting for something to work out, because you don't know what the future will look like. And there could be life circumstances that evolve over that time, your job, your growing family. There's lots of different variables which people don't think about when they're signing up to these properties.
Well, needless to say, we are still not convinced about off the plan property. Of course, never say never. We don't know what the future holds. Maybe they might be built in some really nice areas, who knows, with demand. But as of now, I remain unconvinced about even with negative gearing. I personally would like to avoid them wherever we possibly can. Of course, we don't know about the future.
No, that's right. And I think, look for properties with the highest cash flow and the strongest growth potential, and of course the lowest prices, because that's where all the demand is going to be concentrated. It'll be funneled into those areas. And then, of course, that almost guarantees price growth. I mean, we can't be 100% sure about anything, but those areas have got more potential than any others.
But John, what do you think? Like, people would now be also looking for creative strategies like granny flats. Because Mona and I, when we started our journey, we did a lot of analysis. Do we build a granny flat on a block of land? But we always came to the conclusion it wasn't worth our while to build a granny flat. It was better to put a deposit on a next house than go down this path. Given you said, right, rents will rise anyway. The properties will convert positive cash flow anyway down the track.
Yeah, a lot of the state governments encourage granny flats because it's sort of a temporary, band-aid solution to the huge housing shortage that we have. But they do then create other problems as well, and even just the building of them. Other solutions like short-term rental, Airbnb and stays. That's another way you can increase the rent. But again, there are more issues there, and a lot of local governments and state governments are regulating that industry very strongly. And even in Victoria, there's a surcharge that you have to pay. All these exotic strategies, they might look attractive, and they'll probably be promoted heavily on social media as a solution to the problem, but they usually have their own set of problems as well. And buying a standard house, typical house or typical unit in the right area is still, to me, it's fundamentally the best choice you can make.
So stick to the fundamentals, really. What's worked.
But do you think this will really become law? The negative gearing changes, that is.
Oh yeah, I'm sure they will, because I think the Greens will support them in the Senate, and so the government's got a majority in the House anyway. The Liberals have said we're going to, change everything back when we get into office, and I have great doubts they will, because once these changes have been made, they'll say, well, let's just, leave them. They might fiddle with them a little bit, but there won't be any. I think this is the way it is now, what we're seeing, and it's going to be like that for the foreseeable future.
And but this is the Keating playbook, right? It's been done before. Rents rose significantly. I wonder, whether the government will now start meddling with keep putting ceilings on rents as well. We don't know, but their modelling suggests rents will only really rise by $2 a week, which doesn't make sense because rents have been growing substantially over the last couple of years already.
Yeah, indeed. Now, the Treasurer, Mr. Chalmers, got his PhD. The subject was the speeches of Paul Keating. That was actually the topic. And he did a PhD on that. So, yes, the Paul Keating playbook is well and truly in there. And that we can, well, hopefully we don't see a return to all the other things that Keating introduced, like fringe benefits and, all the financial institutions' duties and things that were just a nuisance, really. But yeah, you can see that it's heading that way. And so whatever else Paul Keating proposed in his speeches, we can look forward to Chalmers maybe trying to reintroduce those sorts of changes.
John, if I may share, for the last 7 years, I have not really paid much attention to politics other than knowing who might be our local member of the parliament and who our prime minister is. Honestly, I was so focused on the goals for us and Property Twins clients that I didn't even know who Jim Chalmers was. And so, excuse my ignorance, I did not know who he was until this budget came in, and I'm like, why is everyone so stressed out?
Yeah, it's you can with any government, once they come in and they get re-elected, they become more confident, and and I think one thing you can see that the Labor government is very much focused on getting the younger people's vote. They've given the boomers away, and they're just saying, right, now let's concentrate on the millennials. That's where our future lies. And all these changes are the ones that and you look at social media, that all the millennials are talking about negative gearing and capital gains tax, how unfair it is, why older people are getting a leg up that they can't afford, and so on. So I think that's where we see, why these changes have been made more. And I'm very cynical here. It's just to get votes.
And John, just, wrapping up, any hot tips for our listeners?
Well, last time I gave you Port Augusta, and I think that it's done very, very well. I think the Golden Triangle in WA, I think if you look at the very affordable prices, the high yields, the fact that gold is going to keep on going up in price, and so more will be mined. It's a fairly secure type of investment. The inner urban unit markets in Melbourne, I think the yields are very high there, and they're going to go up a lot. So they're the best investment areas. And also I think in central Queensland. Now we talk about coal mining, the Claremont and Moranbah and Emerald. They used to be mining towns. They're not anymore. So because all the fly-in, fly-out mining is pretty much finished, but they're just now rather attractive regional towns that are re-emerging and starting to boom. So prices have gone up. I think in Emerald they went up 30% the last year, and the yields are over 6%. So, there are still affordable areas with good cash flow, and they're the ones you really need to concentrate. And one thing we have done is, the 71 suburbs that I mentioned, we've actually produced a report called John Lindeman's Budget Busters Set to Boom. So if you're interested in getting that report, you can have a look at it on my website, lindemanreports.com.au. And I'm not here to sell my reports, but I thought be good to mention it because you might be interested if you're looking for those lower price bargains.
Absolutely. Well, thank you so much, John, for joining us today at Property Addicts Australia.
It's been a pleasure.
Thanks, John.